please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, green it is because we're still holding up quite decent, 36 points higher, and the mid-cap market is firing away. I also have my next co-anchor for the remainder of the show with me. Varinder Bansal is in the house. Varinder, we have lots to cover, including a couple of very interesting companies on the media side. But before we get to that, some important macro updates as well on GST, because we had some commentary coming in from the finance minister yesterday. The plan is to eventually move towards a 3-rate structure for GST. That's the word coming in from Finance Minister Arun Jaitley, who was in conversation with Jahangir Aziz of JP Morgan at the Hindustan Times Leadership Summit. Take a look.
As far as your collections going up, I think the next stage would be, do you have a scope then for merging 12 and 18? How do you do it? Do you send some items of 12 into 5 and merge them and then come to some interim figure? And effectively then you have 2 rates. You have a 5% and you have a X% for the second rate. And you have a very thin luxury rate as far as the top is concerned. I think eventually that will be the direction. But how fast you can do it will depend on how the revenues pick up.
Okay, so that's the finance minister. Everybody's trying to guess what happens to the GST numbers. Speaking of numbers, but Varinder, obviously auto sales on our radar as well. And again, I think the problem, as we were discussing with the analysts, is that how will you analyze these numbers? Month on month doesn't make sense because festive season, year on year, demonetization.
I'm sure Naveen will be there to cover auto sales number. But, one stock which I really want to point is JSW Energy. There is something which is cooking in JSW Energy. And after a long time, the stock will be hitting that fresh 52-week high. Look at the chart, the weekly chart of JSW Energy, and the way the stock is moving up in the last 5 or 10 minutes of trade. We all were thinking about some resolution coming in from a PPA, but then again in the last few months we've been hearing about the electrical vehicle
renewable play
associated with this. I think this stock in the last week or so was some 80 rupees. From that price, it has come to 88. It has been moving up. There is something cooking in there. Just keep an eye on JSW Energy for sure. And now hitting, I think 88 was the 88.40 was the 52-week high. So hitting that mark.
Quite a mover, really. The cap market anyway doing extremely well, and JSW Energy is a case in point.
52-week high today.
Absolutely. Okay, now on to Motown. Let's get a heads up on what to expect from all the auto majors. November sales. Naveen, good morning.
Good morning, Surbhi. Yeah, we saw a disruption in the base year of November last year because of demonetization. So that will have a low base effect, and that will be clearly seen across all segments, yes. But the biggest impact will be seen in commercial vehicles, followed by two-wheelers, tractors, and then passenger vehicles. Also, breaking it up segment-wise, passenger vehicles, Maruti is expected to post its consistent growth. Remember, they have a long waiting period of close to 2 to 3 months, so that will bode well. On the other hand, commercial vehicle side, as I told you, they were the biggest, I would say, adversaries. Now, we are understanding from other CV players that both LCV as well as MNHCV both have been showing parallel growth. So that will bode well. On the other hand, two-wheeler players, because of the new launches, you expect strong growth from all the two-wheeler players. Now, breaking down to numbers, Maruti is expected to post around 13 to 14% growth year on year. On the other hand, Tata Motors, 23%. The tractor segment for M&M, that is expected to grow 26%. On the other hand, Eicher, remember, consistency is what the company has been going for in the last 3 to 4 months. So 23% growth is what Eicher is also expected to post. Among the other two-wheeler players, Hero as well as TVS are expected to post robust growth. TVS, in fact, is expected to post a growth of close to 22 to 23%, majorly led by their motorcycle as well as their moped segment. Back to you.
Shruti, as you can see, JSW Energy, is up now 6%. It's something happening there over there. And on the auto, keep an eye on Ashok Leyland. I think that could be a dark horse because as the price is indicating, and the F&O build up, in the cash volume build up, it's Ashok Leyland since morning which is moving up nearly 3.5% among all the auto pack.
Absolutely. So auto in focus, JSW Energy in focus. Another stock worth keeping on your radar this morning is definitely SAIL. It's up almost 5% at 80 rupees, and there's a Phillip Capital report that's come in. Their target price, I think, is 120, and they think it's a buy. Let's get in Nigel to understand what makes Phillip Capital so bullish on SAIL. Nigel?
Imagine that, Surbhi, going from sell to buy and your target price going up by 2.5 times, telling you that they definitely believe that this is a contra bet and it's going to do well in the future. That's what Phillip Capital really has to say. What was the problem earlier with SAIL? One was that the capacities were getting delayed. That's point number one. The second point was their product mix was fairly weak. Why? They were selling more amount of long products as well as semis. So that was the reason why, in fact, they were not really being able to get that entire realization expansion. Now they are counting on this really playing out. The share of semis coming in lower, and in fact, the long product prices scaling up as well as demand coming back to the fore. In the last 5 years, SAIL in terms of volume growth has been only around 2-3% approximately. In the same time, if you take a look at Tata Steel as well as JSW Steel, their volume growth has been to the amount of around 10 to around 15%. So clearly, SAIL has some catching up to do. But the key reason why SAIL really drags everyone, just take a look at these numbers. Okay, SAIL, they employ close to around 75 to around 80,000 employees. And they produce roughly around 13 to around 14 million tons in the past year. JSW Steel, they employ nearly 1/5 of those number of employees. And in fact, they produced more than what SAIL produced in the last year. So just keep that in mind. In terms of a cost per ton, I was doing some rough math, and SAIL pays nearly around 5,000 to 6,000 rupees per ton in terms of employee costs. JSW Steel pays only around 1,000 rupees. But the big talking point and the reason why the stock is higher is because, in fact, Phillip Capital, they're very bullish on it. They have a buy rating, as you all said, target price of around 120 rupees. They're valuing it at around 1.5 times price to book. And they believe that the company is set to turn around. Employee costs could come in lower. Profitability will increase going ahead as well. And they're going to be key beneficiaries of the demand that's coming back to long products and product prices moving up. Back to you.
Well, Nigel, I have a question for you. For the longest of the time, you have educated me, about how Tata Steel, JSW Steel, they are superior in terms of every ratio, which, you can count in the metal metrics. Are you convinced with this note? Because I remember you never had that positive view on SAIL because of the the numbers, the employee cost, EBITDA per ton, efficiency and everything. Do you think, apart from the numbers, there could be some other news, some M&A buzz, which is keeping the stock alive since last many months? Or is it too much to expect in terms of numbers from SAIL immediately in the next few quarters?
Well, firstly, I have no view on the stock. That's point number one. The reason why, in fact, we've been downbeat on SAIL is because they've been reporting reporting net losses for the last many quarters. Now, in the last quarter, they turned it around. You remember we had the steel secretary that joined us and said, I'm looking to turn it around. And in quarter two, yes, Varinder, they did turn it around. Now, in terms of other news, Varinder, there are various debate points. Can someone come in there, put in more equity into the company? I don't know whether or not that can happen, because the market capitalization is roughly around 40,000 crores approximately. The total EV is roughly around 75 to around 80,000 crores. So that's something that plays on the mind. And the other factor, Varinder, is that some part of the street is hoping that they'll go ahead and acquire some of these assets. The point being that I think SAIL should first get its own house in order. They should start delivering these operational profits, as Phillip Capital has clearly spelled out. They're expecting the EBITDA per ton to scale up from here. And then, in fact, they could look at other acquisitions. But they've thrown in their hat for various of these stressed assets. I know your guess is as good as mine, Varinder. But the stock, remember, in September was at around 60 rupees approximately, or a little less than that. So from there, it's already seen a good rally. But Phillip Capital believes that's more to come from here.
Well, I totally agree with Nigel. Okay, I think you got to wait for the numbers before you jump into SAIL. It's only one note which has come in. Please wait for more brokerages, or at least some action on the ground in terms of numbers to come in. Better companies, in the metal space. Yeah.
Anyway, it has had a run, as we've seen. On to a different stock, however, now, M&M Financial. It's actually holding up quite nicely. M&M Finance is looking at raising some money. They've launched a QIP book. And the pricing is slightly lower than where the stock is trending right now. Nimesh has those details. Nimesh, good morning. Fill us in.
Morning, Survey. So, I think the stock reacted positively simply because there is not much discount to yesterday's closing price in the QIP book. They're looking to raise $165 million at an offer price of between 435 and 440. I believe the kind of demand which has got, mostly it will happen at 440 rupees per share. And probably that's the reason why the stock has reacted positively. Survey, what happens is for a financial company to get money, $165 million at this level will mean that the book value goes up for M&M Financials, and that will really mean that they can go out and have further growth. So that's the key reason why the stock is buzzing in trade today. And I believe there was a very strong demand overnight. So mostly both FIs and DIs would participate at a price of 440 to get into this QIP book.
Okay, all right, Nimesh, many thanks for that. Now, of course, it is time for our promised discussion on media. As we told you, we'll be featuring two different companies. Media stocks have been in the limelight. They have been finding favor with several veteran investors as well. Hiren Gada, whole-time director and CFO at Shemaru Entertainment, is now joining us on the line. Hiren, good talking to you today. And, I'll start with a very basic question. We're living in an age of, data explosion. If I look at what you did in FY17 as a whole, your revenue was up 13%. Now, as you're looking at digital content and monetizing, the digital space, and there's a lot of talk about the new deals that you could do with the likes of maybe, Balaji Alt with Amazon, I don't know, Netflix. What's the game changer? Can we expect a revenue game changer in FY18 and, more importantly, FY19?
Morning, Surbhi. See, basically, we have two broadly, as we've been reporting also, we have two streams of revenue. The traditional media, which steadily has been declining as a share of the overall pie as the new media business has been growing. And new media, for the last 5 years, has been growing at a CAGR of 50% plus. Obviously, now it is on a higher base, so going forward, so the industry projections for new media are anywhere around 30 to 35%, and we think that we should be doing better than that in terms of the digital business. And you rightly said that there's been a massive explosion in video consumption post the big data push that has happened post Jio. In fact, we have ourselves reported views on YouTube, for example, as an indicator where pre-Jio we used to do probably about 4 million daily views, and the last June quarter that we reported, we actually crossed 12 million daily views. So it's just gone up in a massive way. And it's not only YouTube. The other various other video platforms have been growing at a very rapid pace, be it Hotstar or Jio's own platform, etc.
Hiren, my name is Varinder. Of course, new media has been doing phenomenally well in the last many years, as you said. But new media is 20% of your revenues. First, I want to check with you. We have been talking about that deal with some of the larger companies like Netflix or Amazon or anyone. Where do we stand over there? Has anything fructified over there or not? One thing, and of course, importantly, the content what we have is very old. Have you added more content in the last 1 quarter or so?
So, 2 questions and I'll answer each of them. With the kind of content, I'll answer the content question first. We have been replenishing the content library. As a strategy, we have never been part of the first cycle of monetization, which is typically the first 5 to 7 years of a film. So our library, by definition or by strategy, has always been release minus 5 to 7 year old always. So typically bulk of the business is around. So we have movies like Ajab Prem Ki Gajab Kahani, Jab Bhi Met, Golmaal Returns, Mujhse Shaadi Karogi, Om Shanti Om, Main Hoon Na. So there is a constant replenishment happening, which is a refresh to release minus 5 kind of or release minus 7 kind of age. So that is a constant investment, and which, if you see the balance sheet also, the investment is reflecting on that.
Absolutely.
Secondly, more importantly, we have now built a position where no one running a meaningful Bollywood service anywhere in the world can run that service without some content from Shemaru. Whether it be 50 films, 500 films, it doesn't matter. But we are a integral part of virtually any service. And therefore, to extend the first question that you asked, I mean, today we have our content deployed on all major platforms in the ecosystem, be it Netflix, be it Hotstar, be it Jio, be it Hook.
Any additional
you name
deals,
it, and virtually most of the key platforms in the ecosystem.
Any additional new platforms, new tie-ups that you might be in?
Commenting on any specific. So it's a constant thing happening, whether it be 5 film deal or 50 film deal. Virtually, every few days we are signing up something or the other. So I would given the various confidentiality clauses, I would resist talking about any specific transaction because
okay, I'll take Surbhi's question and want to ask from you. The sales grew at 13% in FY17. When can we see 20% plus growth coming in terms of income out of all what you said and told us? One thing. And second thing, my biggest, a small worry in analyst mind is that whether companies like yourself can compete with the bigger boys who have so much of money to, put into the market. We all have seen how investments from Amazon, Netflix are moving into the market. They are not worried about cash burn or not. Whether, the smaller players like yourself, Balaji and all will be able to compete with them or not going ahead.
So, I think about competition, I guess only time can tell. But one thing that we have focused on is building the content library, and considering that any service that runs, ultimately the backbone of any service is the content. So in that sense, technology has never made, has always enhanced the long tail monetization of content, and that really has been our thought process. So I understand that there is obviously a large investment happening by some of the international players or some of the new larger Indian players. However, what we are seeing is a bulk of that focus in terms of where the real fight is, that's on the new film segment, and that's really a segment where we are not playing.
Okay.
Typically, these are rights which most of these people that are acquiring are for a 3 to 5 year period, post which anyway the rights are opening up, and that's really where our play begins.
Got your point. Take your point. But Hiren, I want to go back to a number that you gave us. You said because the base is becoming big, new media growth is going to go down to 30 to 35%. That's a serious deceleration because you've been doing 40%, 45% in the good quarters. What will the revenue mix be like by the time we finish FY18? What's the targeted revenue mix by FY19?
Yeah.
And then I want to understand the margin profile of the company. You were at 30% at the end of FY17. So how does that change? Would the revenue mix change?
Okay, so I'll just clarify what I meant to say. See, we normally don't give a forward guidance. So I was just giving an indication of, so 30 to 35% has been the industry trajectory for the last 4 to 5 years, and we have been doing 50% even in that period. What I meant to say is that while the projection for industry is at 30 to 35%, we would target to outperform that by a decent margin. However, given the fact that since we have had a scorching pace of 50% that 50+% growth may not be sustainable on a higher base.
Of course.
You can, do the maths.
So, Hiren,
hopefully we should be, somewhere in that range. Yeah.
Well, when can we expect?
In terms of the 13% for.
Yeah, the 13% revenue growth.
17 that which we just discussed. Yeah. So if we actually last year what happened was till the Q3 we were actually growing at almost 16 to 17%. It was the demonetization impact which hit us in Q4, where due to ad slowdown most of the broadcasters had slowed down their investment. And because of which we had seen a lowering of the top line on the traditional media front, as a result of which the blended growth came down to about 13%. This year we are more, the first quarter started with that, and we believe that that growth has kind of bottomed out, and the traditional media is also kind of fairly back on track, and which is basically at growing at roughly about 12 to 14%. And in terms of the new media, I think the phenomenal growth continues, and we are just hoping that as the whole data story picks up more, we should see better times ahead.
Well, thank you, Hiren. Please stay tuned with us. We also have Mr. Kapil Agarwal from UFO Movies. Mr. Agarwal, the first question, of course, on the results. The market were not pleased with the results. Both ad revenues per screens and the number of minutes, ad minutes are the lowest since first quarter of FY16. Any comments on the results, sir?
No, I think it has been a very unusual quarter for us. In fact, there have been three reasons of reduction in the ad revenue. One is, postponement there was no good content in the last quarter. Number one. Number two, continuing impact of GST on the corporate revenue, which we had expected actually. But the biggest surprise has been decline in the government ad revenue, which has declined by 43%. And in fact, this whole reduction is because of that. That is a big one, yeah. Because overall impact, corporate ad revenue is reduced only by 8%.
Yeah. What do you think? Why there could be so much of impact from the government side? One thing, and second, most of the corporates are telling us that the GST impact is over, but we are still seeing in your numbers. Do you think that this is the last quarter in terms of GST, impact coming on the numbers, sir?
Yeah, so the government revenue was actually surprising. The overall government spend on the advertising in last quarter and the current quarter has actually declined substantially, which is a surprising part. Even we can't analyze why it is so. There is general slowdown, which now we are seeing little bit of upturn in the current quarter. And the GST impact actually, when we look at the media sector, generally we are seeing that everybody we are talking to in the industry, every media company we are talking to in the industry, we are seeing the GST impact is still continuing. The ad spends have gone down, and particularly in our industry.
Okay, so then what's the outlook? Second half in FY18, do you see ad revenues improving? If you could leave us with some sort of a projection for the year as a whole?
Well, we have always been giving the guidance for the year and for the quarters, but currently the situation is so uncertain that I would avoid giving the guidance, at least for now. But generally, I think the revenue is now seeing a little bit uptake, and some content pipeline is also improving in December, January and March. We are seeing some good movies coming, so I'm sure that upturn should happen. But as I said, that half of our revenue comes from government, which is not the case with the other media companies. So that is where actually we got impacted substantially because of reduction in the government ad expense.
Okay, all right, Mr. Agarwal, Hiren, we'll leave it on that note. Many thanks for joining in and telling us about how your individual companies are doing and just how media trends are shaping up as we look at the sector.
Well, the basic takeaway is that the content companies are very, very confident, okay, like what you saw happening with Shimaru and other companies, but UFO still has a lot of way to go in terms of ad revenues because of the government.
Yeah, so that seems to be a problem. There is also a problem, by the way, with the market.
Yes.
We have lost 30 points from the top, and the mid-cap index has also really cooled off a lot of the excitement with which we began the day. Let's get in our technical experts then, Ashwini, Mitesh and Sandeep Wagle with us. Ashwini, now what? Off the highs, what's the sense now?
See, this is a dip I would like to buy because it's more in the sense of a retest of yesterday's low. So both on the Nifty as well as Bank Nifty, because we didn't get follow through bad news post the fiscal deficit numbers. So chances are that the bears are trying to make a fresh low, and they're not succeeding a whole lot because the market breadth remains positive and several sectors are fairly positive. Given that we overdid yesterday's fall, chances are that at least first half we should be able to hold on and move higher. As far as individual stocks are concerned, Diwan Housing is a buy with a stop of 624, target of 650. PC Jeweler is a buy with a stop of 400, target of 425. And Ashok Leyland is a buy with a stop of 118, target of 130.
Okay, that's 3 buys and a buy on the index itself. Mitesh, how are you reading with this sort of slight dip that we've got early into the morning? What's the strategy?
See, this dip doesn't worry me, but I think, eventually I do expect the markets to head lower. There could be some choppiness after the big decline which we had, and the markets might, just oscillate for a day or two. The levels to watch on the upside would be around 10,300, 320. Unless that is being crossed, I would not be extremely positive. But yet on stock-specific basis, I have 2 buy calls, which are looking very good. DHFL also features in my list as well. So buy with a stop at 623, look for targets of around 655. and I had a buy on JSW Energy at around levels of 86 and a target of around 90. I think it's done a high of about 89.5, but still has come down. Still looks good to me. So try to buy it around 86 with a stop below 84, and 90.91 should be your first target.
Okay, all right. JSW Energy, we're just talking about that big surge that was taking place. And Diwan Housing is on the list of both Ashwini as well as Mitesh. Sandeep, good morning. What are your trades?
Good morning, Surabhi. I would go with a buy in M&M Finance, stop loss of 448, target of 472, and a buy in a SAIL, Steel Authority of India, stop loss 77, target 88.
Okay, first of those numbers, 3.26 lakh units, slightly shy of the estimates. You can see the stock there. I mean, the morning started off quite excited with most of these auto counters, not very inspiring. Exports are up. That should be a good story for Bajaj Auto. We should actually get a comparative figure as well, the quarterly figure as well in just a bit, because exports have been improving, and that's one of the reasons the stock sort of started looking fairly excited. Some green on the screen, and I now have Nimish joining in for the next conversation, which is with Mixo Das of JP Morgan. He's joining us to get us the fine print on their Asian strategy as well as the call on India. Mixo, great pleasure to have you on the show. Thank you very much for taking out the time. And opening thoughts, it's an interesting morning actually that you've joined us on, because we've got the second quarter GDP print. It's making some people optimistic that maybe the worst is behind. Now India's in recovery mode. First thoughts?
No, so from our perspective, India is still looking a little bit lukewarm. So in our country allocation model, we still have a small underweight in India, which has been there for the last few months. But as you say, some of the drivers are starting to improve from here. So GDP growth is recovering finally after the several policy-driven slowdown. And we are starting to see more broad-based earnings recovery, not just in India, but region-wide, really. And that should bring India to a better outlook in the next few months. So we're still waiting for the right time to go step back into the market, at least from a relative perspective. But yeah, on an absolute basis, of course, India continues to hold on around the tops, which is similar to really across all markets in the region.
Okay, so would you look at changing the stance, changing the underweight on India anytime soon? And what are the triggers that would sort of tip the balance in favor of India, Mixo?
Right. So for us, it's really going to be about earnings growth. So India, in the last 5 years, has seen consistent downgrades to earnings revisions. And that's been a real big drag on the market performance overall. So if you look at India's relative performance versus MSCI Asia ex Japan, actually since 2007 peak, there hasn't been any significant alpha. There have been only a couple of periods around the two elections where the Indian market has significantly outperformed. And for us, it's really going to be the earnings story. So once we start to see better earnings momentum in the Indian market going forward, maybe in 2018, that's what we'll be really looking for.
Okay. Hi, Mixo. Thanks for joining in. I was looking at a report where you clearly say that you are comfortable with the valuations for the Asia ex-Japan. But is valuation a bit of a risk for Indian markets, because they are trading at a high end of the valuation, historical averages what they have right now? What's the general sense on the valuations for India?
Actually, I'm not concerned too much about valuations on a country level basis for any of these countries. India valuations, yes, just like every other country, is closer to the top end of the range. But at this point, if you look at EM or Asia ex-Japan valuations relative to developed markets or global markets, for example, it's still closer to the middle of the range, and in fact, at quite a bit of discount to developed markets. So Asia ex-Japan trades at a 24% discount to MSCI developed markets forward PEs, and that's quite a bit of a discount there. Now, in India in particular, our valuations looking higher. I think one thing to consider is the growth expectations, and this is something that we did some work on, where if you compare India's forward PE relative to the 5-year forward GDP, real GDP growth expectations, it matches up quite well, actually. And because growth expectations have been going higher, driven by the reforms that the government has undertaken, I don't see a lot of problems with the valuations where they are at this point.
That's interesting, Mixo. That's an interesting viewpoint, and not a very common one that we end up hearing on India. How much headroom for valuations? I mean, this mix between the earnings catch-up, which is the key thing that you're watching, and where we stand in terms of valuations and prices. How much more headroom? What is the kind of earnings recovery that you will pencil in, given where the market is now?
I don't want to get into like the specific numbers about India, because that's not really what I focus on. But from our perspective, the EM-wide earnings growth next year is about 15%. So India will really have to deliver higher than that to become a relatively more attractive market. In terms of valuations, like I was saying, I'm not really worried about valuations at this point. There's still headroom across markets in India as well to see some further upside or multiple re-ratings here. What I do worry a little bit about is some of the positionings which have been getting very, very concentrated in certain growth areas over the course of 2017. And valuations, especially in the growth style, for example, are starting to look a bit extreme, which is why we've, in the last few days, seen a very significant rotation out of this growth style into more of a value style, which is what we think will be working going forward.
Mixo, you met a lot of investors of late in Asia, in Singapore, Hong Kong. Generally, what's the sense towards India? Because positioning still seems to be a little overweight. Is that a bit of a worry for a lot of global investors?
Yeah, so positioning in India has been traditionally overweight, been there for multiple years. What we are seeing right now is actually overweight positions in India are being trimmed. So it has been coming off really since the peak in early 2015. But even year to date, it's been coming off a little bit. So I would say that investors generally are still positive on the long-term story in India, but the cyclical recovery is not something that anyone is positioned for at this point.
So what are you tactically advising clients, especially for India? Should one continue to be into consumers or sectors which have done well, or it's time to now look at industrials or sectors which have not done well on the back of capex recovery?
Right. I think it's more towards the latter, where we are across the region looking for a rotation from the growth and the outperformers into more of the value styles, which have stocks that have underperformed essentially. So this is in line with what we're seeing globally in terms of economic growth, where we are seeing a rotation or a broadening out from what used to be very narrow drivers focused on trade, on technology and commodities, and into more domestic demand-driven, more capex-driven, or credit growth-driven recovery. So that's going to be our theme in terms of sector and stock recommendations.
Okay, Maruti numbers, they are slightly better than the poll that Naveen drew up for us. We will get you more on those numbers in just a moment. Headline number is better than estimates. More on Maruti in just a moment. But Mixo, then a last question to you. Is there any risk you see on the horizon? I mean, any global risk? Do you see the US mother market rally continuing to be as strong as it has been? And just the general sense on whether the equity run that we've seen in 2017, whether you see that extending into 2018 as well?
Simple answer is yes. That said, we do see several risks on the way, and it's going to be a bumpier road compared to what we've seen in 2017 for sure. And some of the risks that I was previously mentioning about positioning is something that we are watching very closely, especially for many of the systematic and quant investors that have been proliferating across the world. Secondly, I think from a macro perspective, the risk really is a surge in inflation in the US. That's probably the most likely outcome in terms of what rolls over the cycle. But we are not really seeing signs of that yet. So we are following that closely. And finally, in looking at Asia, I guess the risk in Asia from an earnings perspective is if we start to see a much more aggressive deleveraging process in China, which so far has been very targeted and very specific to the financial sector.
Okay. All right, Mixo. Pleasure talking to you this morning. Thank you very much for joining in and giving us your view on a lot of those markets, of course, including India. We will take a break on that note. On the other side, we follow this chat up with another big conversation, another big auto sales. So Bajaj Auto's November auto sales have come in just a shade below estimates. They have largely been in line with the company's own guidance, of course, for the second half. We have Mr. S. Ravi Kumar, President Business Development at Bajaj Auto, now joining in. Good morning, sir. Thanks so much for coming on the call. Your own thoughts about November? It's a bit of an outlier month. I mean, we can't really do a year-on-year comparison because the base was completely skewed. But how would you describe the performance on the domestic side and the growth that we have seen in exports this time?
Yeah. Number one, on a standalone basis in November 17, a total number of 327,000 units, domestic and export put together, confirms the sort of quarterly run rate of a million plus, and that is quite gratifying. So that is very good. This time we should remember that coming to domestic, we had Diwali in the third week of October itself, so Diwali was well gone by when we started November. But I should tell you that, after all the GST and all that confusion there, in the month of, let us say, I'll take you back a bit, in the month of July and August, we were at 15.5% domestic motorcycle market share. We rebounded very nicely to 19.5% in September and October, a similar number. So we were well on course. So that is the story. But typically post-festive, things soften a bit, as you have also sort of alluded to. And this time, the main competition started the discounting party a bit, I think prematurely, a bit in advance. But we have countered that nicely with a good aggressive sales promotion plan. So we should be well on course. This 20% is very much in the pocket. And there are two major nice launches lined up for January itself. So domestic, I think we are quite well on course for an exit market share like we had guided for March to end this fiscal in March 2018 for something like 22-23% market share.
Okay, so domestic market share of 22 to 23%.
Exit in the month of March, and I think that is where we are going ahead. The rebound after GST has been very nice, and as far as November, December is concerned, we have now pressed the button in an aggressive sales promotion very much to meet the competition already. It's out there from 1st of December itself. So this 20% type of a market share on the base of our current product portfolio is very much in the pocket. I should now immediately come to the domestic three-wheelers. Have fantastic and a stellar performance there. 107,000, almost 108,000 units in the last 3 months. This month, 37,887 units, the highest ever. So I think, and this type of run rate is very much visible, at least in the short and medium term, on the back of what is available in Maharashtra, Bangalore, and all those places. So that's on a very, very solid track. Then you also mentioned about exports. Exports, a fantastic number there at 147,000 units for the month. And it's been nicely holding. Month on month it is improving. Many markets are stabilizing. We are well covered as far as Forex is concerned. So I think, again, here, we should end the year much closer to 1.7 million, though we had in the beginning of the year, we had talked, our best in the past was 1.6 or something like that. So I think 1.7 million for the full year on a good, consistent export performance, that is also in the pocket.
So, good morning, Mr. Ravi Kumar. For your domestic motorcycle business, we have seen a 2% growth. I wanted to understand the new launches when we did. How are they faring, the likes of Platina as well as CT100? And going ahead, what will be the monthly outlook that you can give us on that?
See, Platina has been doing extremely well. That is one of the hit launches of the current year. And even post-festive, for example, in the month of November, we have done 52,000 units of Platina 100. So that has been a very, very gratifying performance. And I think there is still a lot of juice there and the demand there. So Platina the launch has been a fantastic launch for us. As far as the new other launches are there, NS family, that Pulsar NS 160 and 200 together, very good for in the domestic market, 10,000 units plus per month number, and that again has had a very huge and nice traction. Going forwards, our new launches, I'll not be able to talk about the launches right now, but they're going to hit the market in January itself. There are going to be two nice launches. The other brands are going to get a boost, and that is why we should be good for, I said, the exit market share of around 22-23% in March 18.
Okay, sir. Noted. We'll look out for those January launches. All the best. Thank you very much for joining in right now. That is